If you've ever deposited cash into your bank account, transferred money between accounts, sold a car for cash, or received a large payment from family, there is one banking rule you absolutely need to understand before it's too late. Because the moment you cross a certain threshold, your bank is legally required to report that transaction to the federal government. Not because you've done something wrong, not because you're under investigation, simply because the law says they must. And here's what scares me. Most Americans don't get into trouble because of the report itself. They get into trouble because of what they do after they learn the rule exists. That one mistake has destroyed savings, frozen accounts, triggered federal investigations, and caused honest people to lose access to their own money. I'm going to explain exactly how the $10,000 rule works, why banks monitor your transactions so closely, and the 5 situations where ordinary Americans accidentally make themselves look suspicious without realizing it. Because once the system flags your activity, fixing the problem becomes slow, stressful, and expensive. The rule starts with something called a Currency Transaction Report, or CTR. Under federal law, banks are required to file a CTR anytime a customer deposits, withdraws, or transfers more than $10,000 in cash during a single business day. That report goes to the Financial Crimes Enforcement Network, known as FinCEN, which operates under the U.S. Treasury Department. Most people think this means the IRS is immediately investigating them. That's not true. Millions of these reports are filed every year. Most go nowhere. Nobody calls you. Nobody shows up at your house. Nobody freezes your account. The report itself is routine. But here's where people create real problems for themselves. The moment someone hears about the $10,000 rule, they panic. They think, I'll just deposit $9,000 instead. I'll spread it across a few days. I'll use different bank branches. I don't want the government watching me. That instinct is exactly what gets people flagged, because under federal law, intentionally breaking transactions into smaller amounts to avoid reporting requirements is called structuring, and structuring is a federal offense. The government does not need to prove the money was illegal. That's the part most people don't understand. You could be depositing perfectly legal money, money from selling a car, an inheritance, retirement savings, a family gift. It doesn't matter. If investigators believe you intentionally tried to avoid the reporting threshold, the activity itself can become the problem. And modern banking systems are extremely good at spotting patterns. The software doesn't just look at one transaction. It looks at behavior. A $9,000 deposit Monday, another $8,500 Wednesday, another $7,000 Friday. To a customer, that may seem harmless. To the bank's software, it looks intentional. And once the system flags a pattern, the bank may file something even more serious than a CTR, a Suspicious Activity Report, known as a SAR. This is where situations become dangerous. Unlike CTRs, Suspicious Activity Reports are secret. Federal law prohibits the bank from telling you one has been filed. You will not receive a warning. You will not get a phone call. You may continue using your account normally while investigators review your activity behind the scenes. And many people never realize there's a problem until their account suddenly becomes restricted. Now, let me show you how ordinary people accidentally trigger these situations every day. Scenario 1, selling a vehicle. A retired couple sells their RV for $18,000 cash. The buyer doesn't want to use a cashier's check. The couple becomes nervous about depositing such a large amount at once, so they split the cash into smaller deposits over several weeks. Instead, they create a pattern that looks suspicious. The safer move would have been depositing the full amount once and keeping a copy of the bill of sale. One clean transaction. Clear documentation. No suspicious pattern. Scenario 2, moving your own savings. This catches retirees constantly. Someone closes an old bank account and slowly transfers money into a new one in smaller amounts because they don't want large transfers attracting attention. But multiple unusual transfers often attract more attention than one large documented transfer ever would. Banks expect legitimate large transactions. What they don't expect is behavior that looks like someone trying to stay invisible. A parent gives their adult child $15,000 to help with a down payment or medical expenses. Completely legal. But then someone says, keep it under $10,000 or the IRS will come after you. So the money gets broken into pieces, different deposits, different days, different branches. Again, the behavior becomes the problem, not the money itself. Scenario 4. Sudden online income. Someone sells crypto, stocks, or an online business and suddenly receives tens of thousands of dollars into an account that normally only sees ordinary paychecks. The bank notices immediately because the activity doesn't match the account's normal history, and then the customer panics and starts rapidly moving the money between accounts, trying to spread it out. That reaction often creates even more suspicion. Scenario 5. Saying the wrong thing at the bank. This is one of the biggest mistakes people make. A teller asks, "Where did this money come from?" And instead of calmly explaining the source, the customer says, "I don't want this reported. How much can I deposit without triggering the IRS? Should I split this into smaller deposits?" Those statements can instantly change how the bank interprets the transaction, because now it sounds like the customer is intentionally trying to avoid reporting requirements. The safest thing you can do is simple. Tell the truth. Keep it short. Keep documentation. If you sold a car, bring the bill of sale. If you received a gift, keep a gift letter. If you're transferring savings, keep bank records from both accounts. Paperwork protects you. Panic destroys people. Now, I need to say something important because many Americans misunderstand how these laws work. The government is not trying to punish ordinary people for depositing large amounts of money. Large transactions happen every day. Businesses deposit cash, families transfer savings, and people inherit money. The real issue is not the amount. It's behavior that looks suspicious, hidden, or intentionally designed to avoid reporting rules. Once banks believe someone may be trying to dodge those requirements, the situation becomes much more serious. That's why the smartest thing you can do is keep clean records instead of worrying about being reported. Documentation is your protection. Create a folder called Transaction Records. Whenever you move a large amount of money, save anything that proves where it came from. Transfer confirmations, receipts, bills of sale, gifted letters, or bank statements. You may never need those records, but if questions ever come years later, you'll be glad you kept them. The $10,000 rule is not meant to trap ordinary people. Most problems happen when people panic, hide transactions, or try to outsmart the system. The rule is simple. Move your money honestly, keep your paperwork organized, and never structure transactions to avoid reporting limits. In today's banking system, the behavior around your money matters just as much as the money itself. If this video helped you, share it with someone who handles cash often, owns a small business, or manages family finances. And let me know in the comments, did you already know about the $10,000 rule before watching this video?